Want to grow your wealth? Looking for a simple and safe way to do it? Dividend investing might be your answer. It's a powerful strategy that can help you build wealth over time. This essay will guide you through the basics of dividend investing. You'll learn how to get started and make informed investment decisions. Investing can seem daunting, but it doesn't have to be. Dividend investing is a great option for beginners. It's easy to understand and can provide steady returns. Let's dive in. This could be your future with smart dividend investing. We'll show you how. What exactly are dividends? Imagine owning a piece of a company that's making money. As a shareholder, you're entitled to a share of those profits. That's what dividends are. They are payments made by companies to their shareholders, typically from their earnings. The most common type is a cash dividend. Companies distribute these payments regularly, often every quarter. Think of it as a bonus for owning their stock. When you receive a dividend, you can either spend it or, better yet, reinvest it to buy more shares. Dividends, your share of a company's success delivered right to you. Reinvesting your dividends is where the magic of compounding comes in. By choosing to reinvest, you allow your earnings to generate even more earnings. This is the essence of compounding, a powerful financial concept that can significantly boost your investment returns over time. Compounding is like a snowball effect. Imagine a small snowball rolling down a hill, gradually picking up more snow and growing larger. Similarly, your reinvested dividends accumulate more shares, which in turn generate more dividends, creating a cycle of growth. When you reinvest dividends, you buy more shares. Each new share you purchase adds to your investment base, increasing the potential for future earnings. This continuous reinvestment can lead to substantial growth in your portfolio. These new shares earn dividends too. It's a self-perpetuating cycle where your investments keep growing, and the dividends from these new shares further enhance your returns. Over time, your earnings grow exponentially. Just like a plant that starts from a small seed and grows into a large tree, your investments can flourish and expand significantly through the power of compounding. Let's look at the S&P 500, a popular stock market index. This index includes 500 of the largest companies in the U.S. and is often used as a benchmark for overall market performance. Historically, it has delivered an average annual return of around 10%. This return is based on the price appreciation of the stocks within the index, excluding dividends. However, with dividends reinvested, that return jumps to nearly 13%. This additional 3% may seem small, but it can have a profound impact on your investment over the long term. That extra 3% might not seem like much, but over decades, it can make a huge difference in your portfolio's growth. The longer you stay invested and reinvest your dividends, the more pronounced the effects of compounding become. Compounding. The key to turning small, consistent investments into significant wealth. By understanding and harnessing this powerful financial principle, you can set yourself on a path to achieving your long-term financial goals. Now you might be thinking, can't I just buy stocks that go up in price? Why bother with dividends? That's called growth investing. While it can be lucrative, it's important to understand the difference. Growth investors focus on companies expected to increase in value rapidly. They aim to sell their shares at a higher price later. Dividend investors, on the other hand, prioritize companies with a history of consistent dividend payments. They seek a steady stream of income from their investments, especially during market downturns. Both dividend and growth investing have their merits. The best approach depends on your individual goals and risk tolerance. Section 5. Setting your investment goals. Before you start investing, it's crucial to define your investment goals. These goals will serve as the foundation for your investment strategy and guide your decisions along the way. Without clear goals, you might find yourself making impulsive decisions that could jeopardize your financial future. What are you hoping to achieve with your investments? Are you looking to build a nest egg for retirement? Or perhaps you want to save for a significant life event like buying a home or funding your child's education? Are you saving for retirement, a down payment on a house, or your child's education? Each of these goals requires a different approach and timeline, so it's important to be specific. Setting clear goals will help you stay focused and motivated. When you have a clear vision of what you're working towards, it's easier to stay disciplined and make informed decisions. It's also essential to make your goals specific, measurable, achievable, relevant, and time-bound, often referred to as SMART. This framework ensures that your goals are realistic and attainable. giving you a clear roadmap to follow. For instance, instead of saying, I want to save for retirement, set a target like, I want to accumulate $1 million in my retirement account within the next 20 years. This gives you a clear target to aim for and helps you track your progress over time. Clear goals provide direction and purpose to your investment journey. They act as a compass, guiding you through the complexities of the financial markets and helping you stay on course even when faced with challenges. By setting well-defined investment goals, you can create a solid foundation for your financial future and work towards achieving your dreams with confidence. Section 6. Risk tolerance and time horizons. Understanding your risk tolerance is another vital aspect of investing. Risk tolerance refers to your capacity to handle potential investment losses. Are you comfortable with market fluctuations or do they make you nervous? Your time horizon, the length of time you plan to hold your investments, also plays a significant role. If you have a long time horizon, such as decades until retirement, you can afford to take on more risk. Shorter time horizons might necessitate a more conservative approach. Knowing your risk tolerance helps you choose investments that align with your comfort level. Section 7. Short-term and long-term dividend strategies. Dividend investing offers flexibility for both short-term and long-term investors. Short-term investors might prioritize high-yield dividend stocks. These stocks pay out a higher percentage of their earnings as dividends, providing immediate income. Long-term investors often focus on companies with a history of dividend growth. They reinvest their dividends, allowing them to benefit from the power of compounding over time. A balanced approach that combines both strategies can also be effective. Your investment time horizon influences the dividend strategy that best suits your needs. Section 8. Choosing the right stocks. Key criteria. Selecting the right dividend stocks is crucial for success. Dividend stocks can provide a steady income stream and potential for capital appreciation, making them a popular choice for many investors. However, not all dividend stocks are created equal, and choosing the right ones requires careful consideration of several key factors. Here are some key factors to consider when evaluating dividend stocks. Dividend yield. This indicates the annual dividend payment as a percentage of the stock price. A higher dividend yield can be attractive because it means a higher return on your investment. However, it's important to look beyond the yield percentage and understand the underlying factors that contribute to it. Higher yields can be attractive, but be cautious of exceptionally high yields, as they might signal financial instability. Companies offering very high yields may be doing so because their stock price has dropped significantly, which could indicate underlying problems. Always investigate the reasons behind a high yield before making an investment. Dividend growth history. Look for companies with a consistent track record of increasing their dividends over time. This demonstrates not only the company's financial strength, but also its commitment to returning value to shareholders. Companies that regularly increase their dividends are often more stable and reliable investments. This demonstrates financial strength and a commitment to shareholders. A company that can consistently grow its dividends is likely managing its resources well and has a positive outlook for future earnings. Payout ratio. This measures the percentage of earnings paid out as dividends. A lower payout ratio suggests that the company is retaining a significant portion of its earnings for reinvestment and growth. Conversely, a very high payout ratio might indicate that the company is paying out most of its earnings as dividends, which could be unsustainable in the long run. A payout ratio below 60% is generally considered healthy, indicating that the company retains enough earnings for reinvestment and navigating challenges. This balance between paying dividends and retaining earnings is crucial for the long-term sustainability of the company. Overall financial health. Consider the company's debt levels, earnings stability, industry outlook, and management team's track record. A company with high debt levels may struggle to maintain its dividend payments during economic downturns. Similarly, a company with unstable earnings may not be able to sustain its dividend payments. Thorough research and analysis are essential when choosing dividend stocks for your portfolio. By considering these key criteria, you can make more informed decisions and select dividend stocks that are more likely to provide stable and growing income over the long term. Remember, investing in dividend stocks is not just about chasing high yields. It's about finding quality companies with sustainable dividend policies. Section 9. Taking action, embracing dividend investing. Dividend investing offers a compelling path to financial independence. By understanding the basics of dividends, harnessing the power of compounding, and carefully selecting your investments, you can build a portfolio that generates passive income and grows your wealth over time. Remember to set clear investment goals, assess your risk tolerance, and choose a strategy that aligns with your time horizon. With patience, discipline, and the right approach, you can achieve your financial aspirations through the power of dividend investing. Take charge of your financial future and start your dividend investing journey today.